Recently, Alibaba's share price fell by 15% despite recording record revenue for their Singles Day promotion. The reason? A draft on an anti-monopoly rule by the China government. Now, this anti-monopoly rule is still on its very early stage. That's why it's called a draft. But if it's come true, it means that many of the existing practices by companies like Alibaba, JD.com, even Tencent, whereby they are using customer data, aggressive techniques to acquire customers by giving discounts, sometimes even selling things at a loss. That's why initially all these companies like Amazon, Alibaba, all these were losing money just to acquire a customer for long term. And this technique actually created a huge barrier for entry. Like smaller company, people with not much capital, they cannot come and compete because you have to be bleeding in the initial stage. So this made these companies very competitive, and that's how they grow so fast. The same thing that is helping all these tech giants in China to grow is also the same thing that is causing this recent setback on their share price and maybe even on their potential growth in the future. Now, because this is not a one-off incident, remember I just made a video on Ant Group's IPO, 5 things you need to know, and where I say, oh, regulatory risk is one of them. Right after I made the video, what happened? The Chinese government just slapped a new regulation on Ant Group, which totally changed their business economy because now they have to put more capital. It makes them a bit less profitable, and their ability to grow will be seriously hampered. That's why the IPO is not a go ahead. So risk like this from the Chinese government, regulatory risk, especially as you get bigger, is a real risk. I'll give you another example. I invested in a company called China Maple Leaf. This company provides education. They are like a private school. And what happened? China government is thinking to draft a new regulation on education company that may hamper their ability to grow and the way they operate. This created a lot of uncertainty around that company, and subsequently the share price dropped by 20% in just one day. Now, the example that I gave you just now is not even the serious case. Those few cases just now, maybe even if the regulation come through, will only limit their ability to grow or the speed of their growth. But eventually, these companies can still perform. But there are also times where these regulations actually wipe out the entire business of the listed company. For example, if you look at one company called Kudian, this company is a peer-to-peer lending platform. What happened? Chinese government say, you know what? From now on, we don't like you guys doing peer-to-peer lending because there are so many shenanigans. Maybe you're not one of them, but I don't care. Most of you have to close down unless you have a very good, valid reason. This caused the Kudian share price to crash dramatically, and the business is also affected. So what I want to say is, when you're investing in a Chinese company, even if they are listed in US, but as long as the operation is in China, you have to bear in mind this risk of potential regulation. Ask yourself, is this company getting so powerful that the Chinese government may want to step in to add a new regulation to them? And if that's the case, what kind of regulation is that? And can you accept knowing these regulations will come to this company and you're still okay with investing in them? That said, not all the Chinese companies will be subjected to regulatory risk. A way to think about it is like this. You ask yourself, the company that I'm investing in, is there any way where they will become too powerful or they will affect the people's life somehow? And this effect is big enough or significant enough or serious enough that it will worry the Chinese government. If it's not, then you don't have much to worry about. But if there is a huge potential for that, then this could happen. If you look at all the cases now, it's about when it comes to money, lending activities, banking activities, education. If they are in this kind of market or people's privacy and data, then you have to be careful. Number 2 is, especially if you are doing tech, the Chinese people is actually very aware, and the Chinese government is also trying to encourage their citizens to adopt technology. And when the government wants to do something, it's really being done in a serious way. So that's why you see all these Chinese companies, in some way, they are much more advanced than their English or US counterparts. Moreover, Chinese middle income class population is expected to double in the next 5 years, and most of the middle class income users are those people that are generating huge revenue for all these super giant companies. So even though they are already so giant, I believe there is still room to grow. So altogether, with the benefit and the disadvantage of investing in these Chinese companies, what would Mingtek do? Would Mingtek still continue to invest in these Chinese companies? For now, I won't be investing in them. Not because I don't think they will do well. I think as a whole, they should do pretty well. But I believe they are better investments with less unexpected risk and uncertainty that can grow as well, if not faster than these Chinese companies. So why don't you just stick with that? Again, you don't need to invest in so many companies. You just need to invest in maybe 5 that you have high conviction, you've done a lot of research, and super good quality companies. These 5 companies, you invest in them, 5 years, 10 years down the road can give you super good return on investment. In the future videos, I will be sharing some of the companies that I personally am investing in, and I'll share with you why as well. If you like this video, hit the like and subscribe button to stay in touch with me so that you get notified the next time I release a new video.